Today, fixed mortgage rates to the moon. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. Today I'm joined by Steve from Canstar. Hi Steve.
Hi Martin.
Great to have you back on the show and thanks for coming on. And boy, we've got some news to discuss today, haven't we?
Oh, we have. Yeah, look, it's all happening, Martin. It's all happening in interest rates around the market for borrowers, for savers. It's plenty to talk about.
Yeah, and I guess one of the headline items is that CBA has just come out and pretty much lifted their fixed rate loans by, wait for it, 1.4%. 1.4%. I mean, that's huge, right? That means that the cheapest 1 year is now, 5.14 or something. I mean, these are massive rises and way above where the forward market view is.
Yeah, that's actually caught me totally by surprise because of all lenders in Australia, you would think CommBank would be the one that would have the least problem funding their fixed rate home loan book. The wholesale markets fall over themselves for a brand as good as CommBank to lend to. So suddenly bump them up by that much says that they think, look, really, the markets have got it wrong. Rates are going to be higher than the market thinks. The Reserve Bank's got it wrong. Rates will be going to higher than the Reserve Bank thinks. So it's kind of a real wake up. I think it's quite a disturbing view of the future that I think the Reserve Bank is presenting here. And if they're not prepared to, or I don't believe they can sort of fund out for 2, 3, 4, and 5 years at really market rates at the moment, well, it sort of says to people, look, really sort of start battening down the hatches. Rates might be going up more than we actually think right now.
Yeah, I got a theory that maybe because of the uncertainty, they're trying to sort of veer people away from fixed rates. So this is almost saying, well, if you really want a fixed rate, you've got to pay for it, right? But go variable.
Yeah.
I guess the other point there is that we know that a couple of years ago, 45% of new loans were actually fixed, right?
Yeah, they were, but I mean, 2 years ago, the big banks were leading with rates at or below 2%, and they were kind of 1% below their variable rates, their best variable rates. So the world has moved totally, and I guess what that period proved up, because we haven't seen many periods like this before in Australia, and I think what that period proved up is that people will just borrow where the rates are cheapest, and it's
Logical.
not a bad strategy.
Logical, isn't it?
Yeah.
But what it also highlights that you probably, unless you really absolutely needed certainty over everything else, you would not go fixed now, would you?
No, look, you'd have to be expecting the Reserve Bank cash rate to reach well over 4%, really, for the variable rate to be above some of those fixed rates, and that's a big call. And I'm not talking about 4% by the end of sort of 2026 or something. I'm talking about 4% by the end of 2023. And so that's a really big call, and it's probably actually north of 4%. We sort of crunched some numbers the other day and came up with a number, but weren't factoring in a 1.4% increase to most terms by the CommBank into that reasoning.
And they're often a bit of a leader, aren't they? So you'd expect some of the other banks to follow trend, right?
Yeah, look, they are. I mean, they're the biggest home lender in Australia by a pretty big margin, and the big four still dominate 70% of the market. So they really do set the pace, and CommBank has been really the pace setter now for years, and it sort of says, well, that's what we perhaps do have to expect. Others will potentially follow, I think. So it says, look, compete on variable rates. Now that's a natural position for banks when they expect rates to rise. But it says to people, look, don't forget that variable rates will go up. If the CommBank's saying in 3 years' time we can expect to be lending at 6.54%, heck, it says you'll probably be paying a variable rate up around that anyway, and probably a bit more.
Yeah, and I guess that is the point. But I mean, these interest rate shocks now, they're coming thick and fast. And I noticed that consumer confidence is actually pretty weak already, right? But this is going to be
Yeah.
another nail in the coffin, isn't it?
Look, it is, and it's such a big impost to people in their budget that you've got to look at it and say, well, heck, I mean, people get nervous. People are already nervous about what it's costing at the grocery store. You know, what my basket of groceries is costing. People are nervous about that already. But home loan interest rates, the $500,000 loan, your repayments have already gone up by about $200. It's a big number, and expect about the same again if the Reserve Bank moves this month by 0.4 or 0.5%. So it's a bigger cost than people are facing really with their groceries, with filling up the car, and you know, the only one that goes even close to rivaling it is the electricity bill. So it really does hurt people, and on top of all of those other costs going up already, it's huge. And one of the problems with all this is that this interest rate increase, this change in the cycle to increasing rates, has come this time around before wages have gone up substantially. There have been little bits going up and little sectors going up, but generally wages haven't gone up. And normally when you see rate increases, it's on the back of inflation, but inflation also that's driven by wage increases, not by, you know, sort of overseas influences on the cost of oil and stuff like that. So the capacity to absorb the extra repayment hasn't been built up yet. And I think that's a major problem for, you know, people's budgets going forward, and really affordability across the whole sort of home loan book that the banks have as well.
Well, it does beg some very important questions, and it's interesting that APRA came out with their most recent statistics, the quarterly numbers. There are still a lot of loans being written at over 6 times debt to income and a high LVR, and in fact, the number of loans that were outside, you know, normal criteria went up again, which is perhaps one reason why APRA wrote to the banks and say, "Excuse me."
Yeah, look, the buffer is in place, but the buffer was kind of, I mean, we've had a buffer for a long time. Now, when I say a buffer, banks are obliged to look at whether or not you can afford your loan, not just at the 3 or 4% that you're being asked to pay for today by the bank, but by 3% above that. And the buffer is designed for a time where rates might go up, so that you can say, well, I can afford the extra repayment, or the bank thinks I can right now. The difficulty is that if rates do sort of take off a lot faster than anyone would have anticipated, then the buffer is going to be absorbed pretty quickly. And don't forget that rates were up around 8% prior to the GFC, so that's 11 years ago or more. And but you know, they've been up there before, and they've been a lot higher than that if you go further back. But that's still quite recent history. So we might be seeing rates up around that 8% level again. And the Reserve, the CommBank is saying, well, look, we're fixing our 3-year fixed at 6.54%. Well, that's kind of not far off that 8% level for variable.
Absolutely, and it's worth underscoring, of course, the buffer is 3% above the sort of the offered mortgage rate, right? That's the way that it works.
Yeah, that's right. Yeah. So if you're borrowing at the 4%, then the buffer is worked out at 7%. So at least, you know, for new borrowers, that's been considered. But there are a lot of people who borrowed in the last 12 months when rates were 2%. So the buffer for them was worked out at 5%, and so they're going to be well short if CommBank's right about where rates might end up.
Plus, of course, the other thing that's happened is that the cost of everything has gone up much more than people expected, right? So
that's
people's
right.
available funds to service a loan is also under pressure from other sources too. So you put those two things together, and you can see that there could definitely be some problems ahead.
Yeah, that's right. And the Reserve Bank is clearly pinning its hopes on wages actually taking off. That's what the Reserve Bank is pinning its hopes on. So it's a kind of funny argument, though. And you know, if you think, well, we're hoping that wages take off so that borrowers can repay their loans. But at the same time, we don't want wages to take off because that will just aggravate inflation, and then we'll have to increase rates again. So we're caught in a very awkward spiral right now, and it's because look the inflation rate that we're seeing now, 5% with an expectation of 7% next quarter. It is largely, well, half of it's driven by stuff happening outside Australia. It's the conflict in Ukraine and the impact on oil and gas prices, the world prices, which flow through to Australia, and it's supply chain problems, semiconductors not being available, all that sort of stuff. Plus, there are local supply chain issues because of COVID, and we're still getting through that. So a lot of it is supply driven, and a lot of it hopefully will be fixed, but no one knows when all of that will be fixed, really. And so half of it might be demand driven, but if wages do take off, well, the demand will start driving higher prices again, inflation again. So it's really an awkward position. I'm sure the Reserve Bank is sort of losing a bit of sleep over this because it's I'm not sure that they'd be totally confident we'll get the wage increases that will protect the banking market, the integrity of the banking market, and also protect people from losing their houses.
Do you think they're losing credibility through this?
Yeah, look, I think it's been, I mean, you've got to look at decisions made when they're made. And when you think about the start of COVID, when the easing started, I don't think any of us thought there wouldn't be a recession. And I don't think any of us thought that housing prices wouldn't fall. And so, the shot in the arm that came from government through all of those support measures, and also through the Reserve Bank through lower interest rates and lower funding costs through, market activity, it's hard to criticise that because it was made at a time when most of us thought it was needed. But it's unwinding it is the problem that they're facing now because everything's taken off too fast. And to make it a perfect storm, we've got the conflict in Ukraine and we've got all sorts of supply chain issues that we didn't kind of anticipate. Who would have thought there'd be no semiconductors around? So it's hard. It's easy in retrospect to say, look, perhaps got it wrong, but it's difficult at the time to say, would I have done it differently if I'd been in the chair? Well, maybe not.
You can only make decisions on what you knew at the time, of course. But even Lowe did admit that credibility of the RBA was a bit under pressure. But I guess there is a bit of positive news for savers in all of this, right? Because finally, savers are getting a little bit for their money.
Yeah, they are, and it's great news. It's very positive because even when as interest rates fell, cast your mind back to when interest rates were falling. Savings rates were falling faster. Then interest rates stabilised and savings rates kept falling. And the base savings rate at most banks was down around 10, 15 basis points and 5 in some cases. The only thing stopped it going lower and at a lot of banks was that they were not game to go below zero. And so they've had it really tough for a long time. Now rates are on the rise and so are savings rates. Now, if you look at term deposit rates, they have really gone up quite substantially over the last 4 or 5 months. They've gone up as quickly, not quite as quickly, but they've gone up in step with the fixed home loan rates, so the borrowing rates. And that's not unexpected because longer term, if you're going to fund fixed rate loans, you've got to find money in the money markets, and that's gone up. So you'll say, well, okay, we can pay term depositors more because they're still a lower price cost than wholesale rates. So that's why they've gone up. Savings rates have gone up, but nowhere near as much as the home loan rates, and that's kind of disturbing. Now, the banks have lots of deposits because deposits built up during COVID, but it's disturbing that they're not passing on some of this to savers who've been long suffering. And there are a couple of things that they've done that don't work. First up, it's 20% of banks have not passed on a savings increase at all. in the last 2 months, while everything else has been going up. But 80% have. But of the 80% who have, well, they haven't passed on the full 0.75 in patches they have, but not elsewhere. In a single month, they might increase their online savings account, the regular savings account, but not the bonus account. The next month, they might pass on the increase to the bonus account, but not the regular savings account. The interest rate increase sometimes goes to the base account, to the base rate. But in other occasions, it just goes to the promotional rate, which means existing borrowers don't get it at all. So it's been really patchy, and a lot of people aren't getting their share of the increase the Reserve Bank's put through, which is 0.75%, and frankly, very few are getting that. Very few savers.
Absolutely. Well, I guess with all of these movements in rates, there's still the critical advice, isn't it, that you should be shopping around and you should checking to know what your rates are and checking to know what there is in the market, because a lot of people still are not on the most advantageous rates they can get.
Yeah, they're not, Martin. People kind of think, well, the Reserve Bank's gone up, so my bank will take care of me and bump up my rate. Well, historically, when rates are going up, when rates turn, the savings rates go up actually faster than the home loan rate. That's because so much has gone off those rates as rates were falling. But historically, they've gone up faster. We're not seeing it now because the banks have so much deposit money out there, so they don't need to pay for it right now. But they will sooner or later. Now, I'm sure that it will take off, but it's taking a long time. But don't wait for the bank to fix it up for you. Do it for yourself, because you can get much better than the average now. You can get much better than the bank you're probably with right now. And it's, by 1.5% in some cases, or 1.2, 1.3% in some cases. So do something about it now. Don't wait for it, because you might be waiting a year or more before you start getting the sort of rate that you think you should be getting.
Yeah, and the point is, of course, that if you can get a little bit of a better rate on deposits or a lower rate on your home loan, that's real money that you can save. And in the current environment, that's important. I find this frustrating, Martin. You do me
too.
both.
People will pore over the weekly vouchers, coupons, vouchers, advertising, catalogues, etc., to find a way of saving a bit of money on their groceries. And if you can save yourself, $200, $300, $400 per month on your groceries doing that, well, that's pretty amazing. You can save that sort of money on your home loan by getting into one of the cheapest loans in the market from the average sort of rate. And yet people don't do it. And the other thing is you don't have to buy a lesser quality product. You don't have to add another bucket of water to the soup. So it's not hurting your lifestyle. Yeah. Your lifestyle feels just the same. You're just maybe paying your monthly repayment to a different bank. So please, people, go out there and check, because there are much better rates available than the one you're probably on, because you're probably on the average rate, because that's where people are.
And the point there is the switching process has been now simplified so much that it's actually not a really hard task to do anymore, is it?
Yeah, people are still scared. They still think going to the bank manager is a horrible experience. In a lot of cases, you don't have to go to the bank manager at all anymore. And you can do a lot of it online. You can get faster approvals. It's still something you don't want to do every second week. You never take it up as a hobby, but it's a lot easier than it has ever been before. So if you're able to repay your loan now, if you've been making your repayments without missing any, and you're still in work, all those sorts of things, then there's a pretty good chance you can save money by switching. And at the very least, talk to your own bank, because they have lower rates for new people now coming in than the one you're probably on. That's at the very least, but you should go a little bit further than that and look a bit more widely, because there are some great rates around still.
Yeah, and just one last topic before we close. I've just had my latest surveys come back. I've noticed that more people are taking their health insurance off, so they're actually closing it and not getting their health insurance because the costs are so high now. And of course, there's a question about, is that a sensible thing? But what are you observing in the health sector, in the health insurance sector, particularly to come out at the end of the tax year?
Yeah, look, there's been a long-term trend of people exiting that industry. Consumers are saying, look, I'm not getting the value I expect for this, or I can't afford the premiums. And the premiums are really high. Now, the premiums of the last couple of years have actually only increased by about 3% odd, whereas there was a long-term trend of 6%. And that's because during COVID, a lot of elective surgery wasn't done. So claims on private health insurance were actually lower through COVID than in prior years. And some of them have given refunds and one-off payments and stuff like that to actually compensate people for it. But the long-term trend has been that younger people in particular say, look, I can't afford private health insurance and I'm not claiming on hospital cover at all, so I'm getting out of this. Now, that's the group that have been subsidising, if you like, the older people who are the ones who are claiming. And they're actually, the number of people in private health insurance, older people, are actually increasing. So the insurers are finding themselves in a very awkward spot where the group that has been subsidising claims have been declining. The people that are higher claimers have been going up. Now, I'm not surprised younger people are getting out. And subsidising is a really hard word, because in a way, if you join when you're 25 or 30 and you don't claim on private health insurance, you don't claim on hospital, you're sort of subsidising your future years when you probably will start to claim. So it's sort of subsidy sounds horrible that the younger are subsidising the old, but the younger are also subsidising their future claims. But people will pull out. One of the things they should look at, though, is that if their income pips over $90,000, look, get back in. At least then get back into private health insurance, because your basic cover, you can get a basic policy for about the same. What's a basic policy cover? Not much at all. But at least you won't be, you're sort of starting the clock on that lifetime loading. You won't be up for lifetime loading if at least you're in the industry, in the game. So, if you do pip over that, don't ignore that. Get into private health insurance then at least. But yeah, it's a tough industry. It's a highly regulated industry, and I get in these hard times why people would say, no, I'm going public. Unfortunately, that means waiting lists.
And you just mentioned something very important, the lifetime loading. The point is that if you are actually not in the system and you over that income level, you get hit out with tax first. But secondly, it's much more expensive to get in later, isn't it?
Yeah, look, it is. It goes up by 2% every year that you're not in private health insurance beyond the age of 31. So you've got to get in by the age of 31 not to tick over into that 2% the year you turn 31. So 2% per year. Now, in 5 years, that's another 10% on the already pretty hefty premiums. 10 years, 20%. It peaks at 30%, and then it winds off as you've been starting to pay. But it takes a long time to wind off. So you will be up for more later on, and later on you will be saying, look, I should be in private health insurance because I don't want to have to wait for the hip replacement in the public system, which could take a couple of years potentially. I don't know what they are right now. But it's something like $30,000 to get a hip done in a private hospital. And not many people have actually saved up that sort of money. So if you're caught on a long waiting list, well, your life is going to be impacted by it. So people will feel down the track they want private health cover. and will be up for more if they haven't had it from through their 30s and 40s.
Absolutely. Well, Steve, I really appreciate your time today and your insights. And as with all of these things, it's always more complicated the more you look at it, right? So, you go to sites like Canstar, they've got a lot of information there, a lot of comparisons, and very useful information. And as I keep saying to people, educate yourself, understand the decisions that you can make, because there are decisions that you can make that can provide you a much better outcome than probably what you're getting at the moment. And also think ahead, things like health insurance, again, it's not as straightforward as just saying, well, I can't afford that, I've got to stop it, right? There are consequences. So again, it's really important just to keep thinking about those through. Steve, I really appreciate your time today. Thank you so much.
Thanks, Martin. Cheers.
See you. Take care.